Uh, Good afternoon, sir. Are we? Can we start now?
Yes, yes, I
Oh,
can. I can start
okay, sir.
once you.
Sure, sir. Sure, sir.
Yeah.
So, good afternoon, everyone. Both the participants from in-house SSMRV College and participants from different colleges.
You're not audible.
Am I not audible?
And now it's clear.
Okay. So, uh, welcome all. Okay, so welcome to day two of the national level webinar on an overview of IFRS. Uh, we finished day one session yesterday. So now we'll be starting with day two, which is a concluding session. And without further delay, I'll request Milind Date sir to take over the session. Over to you, sir. I've made you the co-host, so you'll be able to share your screen as well.
Yep. Thank you.
Thank you, sir.
Thank you. Thank you. So just give me a second. I'll share my screen.
Okay, sir.
Is the slide visible? Hello. Is the slide visible?
Yes, sir, it is visible.
Yeah. Thank you. So let us start today's session. And as I indicated to you all yesterday, that today we will be discussing about Ind AS 37, which is developed for laying down the principles of creating provisions and recognizing contingent liabilities and contingent assets in the financial statements. Well, like what I said yesterday, today also we'll follow the same pattern, starting with the objective, the scope of various terms used in the standard and the various definitions. And then we'll look at the principles of recognition, measurement, presentation, as well as disclosure. Well, one thing, let me begin today by letting you all know that there has to be always some trigger. That trigger leads to bringing the financial element into financial statements. And depending on the nature of the financial event or a transaction, the trigger points will be different. Now, for example, yesterday we saw that the trigger point was adherence to the 5-step process for recognizing revenue. So before you recognize the revenue, there has to be a triggering event. And the triggering event was existence of contract with customer, the performance obligations, the transaction price allocated, and then satisfaction of performance obligation. So this was a series of triggering events. Similarly, today also, we look at some kind of triggering event that leads us to recognize a provision or a contingent liability or a contingent asset in the books of the company. So let us look at the principles stated in Ind AS 37 in today's session. So as I said, it relates to three different things. One is provisions, second is contingent liabilities, and the third is contingent assets. And all the three terms are very, very clearly defined in this standard. For the first time in India, this standard was notified Notified means it became applicable in 2015 and then amended on 30th of March 2016, 28th of March 2018, and the latest amendment was done on 1st of April 2022. So you should always therefore understand that, look, once established, the standards do not remain static. Depending on the way the business changes come, the business environments change, there may be changes required to be made by the law, statute, within various jurisdictions all over the world. The standards need amendments. And therefore, I always recommend to all the teachers, trainers, tutors, faculty members that learning index is not just a one-time exercise. You will need to keep a very close eye on the developments in the standards. New standards also may come up, replacing the old standards. Existing standards may get amended. And sometimes, certain things from the standard are clarified. So clarification statements, interpretation statements are issued by the standard setters. And we as faculty members must keep a very, very close eye on what are these new developments coming up. And therefore, that's the only purpose why I have included, the notification date as well as the amendment date, just to let you know that, look, these standards are not static. They keep changing depending on the change in the business environment. So with that little background, let me start today's discussion on Ind AS 37. Like yesterday, we'll go through the objective and scope. Scope generally highlights what is excluded. Like in yesterday's standard also, we looked at certain transactions that were excluded. The rest all is there. That is the meaning of it. Now let us look at first the objective of Ind AS 37. There are three very, very crucial statements made by the standard setter in Ind AS 37. So firstly, they say the objective of this standard is to ensure application of appropriate recognition and measurement criteria as well as measurement base to provisions, contingent liabilities and contingent asset. This statement itself sort of defines the boundaries for this standard. So whatever comes within the meaning of provisions, contingent liability and contingent assets would be covered by this standard. And what it lays down appropriate recognition criteria and measurement basis. Recognition criteria is nothing but what I said some time ago, is nothing but triggering event. These triggering events will let you know whether or not these three things should be recognized in the financial statements. If the answer to the question is yes, it has to be recognized, then the next question that you need to answer is, okay, at what value will I make this recognition? What should I include in the amounts? What should I exclude in the amounts? And there is a detailed guidance given in this standard on various measurement bases. And as we go along, I'll explain you that. The second statement that they make is to ensure sufficient information is disclosed to the user to understand nature, amount, and timing thereof. So again, three things stressed over here. I told you yesterday that, look, financial statements are not merely numbers. Although on the body you would see numbers, but there is a lot that happens which result into that number. And as a user of financial statements, I must understand what lies beneath that number. So I want to know, hey, if the provision amount is X, why is the provision made for? What is it related to? Nature. How the company has arrived at the amount? What sort of judgment has it exercised? And of course, what's the timing? I mean, is it something that I have to recognize in the current financial year, or I can defer it to the next financial year? So nature, amount, and timing, all three take care of providing sufficient information to the user, which has to be disclosed. So the part of disclosure is also handled by this accounting standard. And the third and the most important part of objective is safeguarding against possible misuse
Excuse me, I
of.
request the participants to please mute themselves. Mr. K.M. Raghavendra. Thank you. Sorry, sir. Thank you.
No, thank you. Thank you for making that announcement. So third important statement is safeguard against possible misuse of profit smoothing. See, whenever companies prepare and publish their financial statements, there is always a temptation of showing a better picture than what it is, or showing a worse picture than what actually it is. So the standard provides a sort of objectivity, unbiasedness to the whole thing. And that is what is stressed within the objective. Safeguard. Safeguard for whom now? Safeguard for users of financial statements. Stakeholders' interests must be protected by ensuring that accounting is correctly done and correctly reported. So these are the factors that are taken into account when objectives are defined. Let us look at scopes. Now, the scope is simple in the sense it just lists what the standard excludes. And one of the main reasons why these exclusions are made is simply because there are other standards that take care of provisions related to those items, those financial elements. So here's a list of all the exclusions. Wherever a transaction or an event relates to financial instruments, income taxes, employee benefits, leases, insurance contracts, mergers, acquisitions, so there is business combinations, and revenue, the provision related aspects are covered by the respective financial reporting standards. All other types of events are covered under Ind AS 37. So that's about objective and scope of this particular standard. Now, the next important aspect, as we should know, is the existence of various specific terms that find place in this description of the principles stated in this accounting standard 37. So let's look at very crucial 5-6 definitions that are given in Ind AS 37. First is the provision itself. The word provision has to be defined because otherwise entities can take meaning which suits them. That should not happen because that can lead to biased way of reporting, which is not going to be useful for the users of financial statement. So the way the term provision is defined by this standard is very simple. It's a liability of uncertain amount and timing. So they say, yes, a liability, a provision basically is a liability, obligation. So every provision is necessarily a liability, but every liability may not be a provision. Why? Because it clearly spells out that provision is that liability which has uncertain amount or uncertain timing. Please note the word used here is or and not and. So either an obligation has an uncertain amount involved in it or an uncertain timing about it. Let's take a case of, okay, fine, and there is a certain expenditure that is incurred by the company for which the supplier has not sent the bill. So till that, but service is provided by the supplier. Bill has not yet been received. The invoice has not yet been received. So naturally, because the service has been provided, an obligation to pay is created. But because the invoice is not sent, the uncertainty is still there. So here, the uncertainty is related to amount. Sometimes the uncertainty can be related to timing as well, especially where some part of service is provided during the current financial year and some is deferred to the next. So how much is deferred to the next? There is a sort of an uncertainty related there too. So while understanding the definition, tell your students the crux of it. Every provision is a liability, but every liability is not a provision, and explain them with simple real life examples. So provision. Now that they have stated liability, that means there has to be a definition for liability. And that's what the standard has done. What is a liability? Basically, it's an obligation, right? So it is a present obligation. Whose? Of the entity. And the obligation involves what? Obligation involves transfer of economic resource as a result of past events. Now here, the choice of the choice of the wording. A liability is a present obligation. It's not a future obligation. Give you a simple example. We are in 2023, right? And the company says, hey, we have to hold a customer conference in the month of April 2024, and that will have an expenditure, let's say, of 2.5 crores. And the company says, hey, we must provide that in our financial statements for the year ended 31st March 23. As on 31st of March 2023, is this going to be the present obligation? No, it's a future obligation, right? So company has not created any past event that has gone ahead and created this obligation. The training is not yet done, or the customer conference is not yet held. And holding of customer conference or holding of a training session is a past event. So unless that event actually occurs, a present obligation is not created. And naturally, when a present obligation as a result of past event is not created, the event cannot be a liability. And if it's not a liability, it cannot be a provision, because provision is ultimately a liability. That's how you should be able to teach to the students. Let me tell you very frankly, provisions is one such area which is always a bone of contention between the entity and auditors, whether it is internal auditor or an external auditor. It's not always with the intentional approach that the companies try and avoid provisions. They may just simply miss out because they do not focus onto these definitions. and then try and relate these to the number of transactions that the companies keep on undergoing to decide at the end of the month or end of the quarter or end of the year whether a provision is required or not. So for those financial events, those financial transactions, always look at the applicability or validity of these definitions. Yes, thank you for muting. So I hope these things are getting slowly clear to you all, and that's how I said yesterday also, we need to develop a sort of a teaching pedagogy for all of us, which will help us, of course, to teach the students in the best possible manner. Accounting is not just about debits and credits. Yesterday, the whole session, I did not even utter these terms, debit and credit, because accounting is not only that. That's the result. And unfortunately, we teach the students only the result, give entries. That will come much, much later. In a real life scenario, students will need to take decisions and apply them, to decide whether a transaction creates a present obligation. Has it arisen out of past event? If there is no past event, obviously, there is no obligation created. No obligation created, it's not a liability. If it's not a liability, it's not a provision at all. Now, this definition also has mentioned the obligation settlement. How is the company, the entity, going to settle this obligation? And the settlement will happen by transferring an economic resource to the other party. In majority of the transactions, these economic resources would mean payment of cash. So apart from the trading done or some kind of a little barter done, transfer of economic resource would necessarily involve, in real life scenario, I'm saying, payment of cash, of course, through proper banking channels. So what have we understood is provision is a liability, but with uncertain timing or amount. And liability is nothing but an obligation that is created from certain past event. So whenever you want to take a decision of whether the company should make a provision for a transaction or not, you should first ask, is there a present obligation created? That means you should ask, what was the past event that triggered this present obligation? And then only you can take a decision whether a provision is to be made or not. If provision is to be made, the next question that needs to be answered, how much amount should be reflected? And second question that arises is how that amount will be calculated. What is the basis of measurement? So going ahead, we'll see, I'll touch upon all these aspects and show you a lot of practical examples, which I have picked up directly from the standard setting body documents. There are 5-6 examples which we'll discuss at length. I told you that a present obligation should necessarily result from past event. And this past event within the meaning of this standard is called an obligating event. A past event that creates a present obligation. That's why it is called as an obligating event. Let's see how it is defined. It's an event that creates a legal or constructive obligation resulting in entity having no realistic alternative to settling that obligation. Let's understand this a bit more. It's an event that gives rise to obligation. Simple meaning, very simple. What kind of obligation can get created? Either it is a legal obligation that gets created, or it is a constructive obligation that gets created. Legal obligation is such that it can be easily enforced in the court of law. Naturally, by way of various statutes, by way of various laws, a legal and even the contracts and agreements, a legal obligation always gets created. But there is something which is also called as a constructive obligation, although it is not legal that way, but the entity has a past practice of doing or not doing certain things, and that's what creates expectations in the minds of the other party about their claim getting settled. I'll give you examples of this as we go along. So the obligating event that creates the present obligation can either be in terms of a legal obligation or a constructive obligation, and the entity has to settle that obligation. That's why it is saying entity having no realistic alternative to settling. It has to be settled whichever way, by making a payment in full, making a payment in half, making whatever adjustments they like. It has to be settled. No realistic alternative is available than to settle this transaction. So the flow of definitions is very interesting. Provision is a liability. Liability is a present obligation created by a past event. Past event is the event that creates either a legal or a constructive obligation, which the company has to settle. These are the most crucial definitions of this accounting standard, most crucial. So let's look at these two elements that I spoke about. One is a legal obligation, the other is a constructive obligation. Legal obligation is simple. It gets derived from a contract between two parties, a customer and a seller. The contract can be explicit or implicit, like what we looked at yesterday. A liability or an obligation can get created through legislation. For example, there is an environmental act which says, fine, if you are doing this particular business, then you will have to take care of these things. It's a law. And the moment you start creating those transactions, obligation will automatically get created. And sometimes there may not be a statute, but there may be regulations. Regulations, for example, RBI regulations are there, SEBI regulations are there, FEMA regulations are there. So that's covered under other operations of law. So a legal obligation automatically gets created either by contract or a law. For example, there is a contract of employment between an employee and the company. Once the company and employee have signed the contract of employment, obligation to pay salary is triggered. And this is a legal obligation because it is covered by contract. Constructive obligation, on the other hand, is something little different. It's not derived from any law or a legislation or any other regulation, but it flows from companies' practices, companies' actions. As I said, there are two, specific conditions that are included in this definition. Actions where, by an established pattern of past practice or published policies or a sufficiently specific current statement, the entity has indicated to the other parties that it will accept certain responsibilities. So don't go by the kind of complicated wording of this sentence. First thing is very clear to us, it's not a contract, nor a legislation, nor any other operation of law. But company's own past practice, company's own published policies, not internal. It should be published policy, where the company can publish it on the internet, its website. A policy can also be declared for general public through advertisements in the newspapers, or a specifically made statement which may be valid only for a certain time, not on an ongoing basis. And these are the sources of obligation getting created, sources of obligation. And the company has made an indication, has given a signal, alert to the other parties that the company will accept certain responsibilities. And as a result, the entity has created expectation on the part of those other parties that the company will discharge the responsibilities. So a signal by the company or indication by the company that, yeah, it is likely to accept responsibilities. And because this indication is made, other parties validly expect, yeah, the company will settle it. A very simple example of this can be given in the class. Students will understand it very easily. You buy something, let's say, from Amazon. Okay. And Amazon accepts goods if they're returned within, let's say, 48 hours or 7 days or whatever. Now, it's a published policy of Amazon, let us say, that returns subject to conditions 1, 2, 3 within 7 days will be accepted. You don't have to pay for that. It's a published policy, right? So that's neither a contract, nor a legislation, nor an operation of any law, but that's your policy. And in the past, you have been, accepting goods returned by customers within a certain period of time. So therefore, naturally, whenever anybody places order on the website of Amazon, there is a valid expectation in the minds of people that, yes, I mean, there is a published policy of 7-day return. If we return as per the terms and conditions, company will accept it. Now, what is the importance of this definition? Both legal as well as constructive obligation. Remember, these are obligatory events. These are those past events that trigger an obligation. So if there is a contract, a law, or any other operation of law, a legal obligation gets created. Even if it's not present, a constructive obligation can get created if you have a published policy and you have a public practice of accepting those responsibility of accepting the returned product, and thereby create expectations in the minds of customer that, yes, I mean, if I don't like, no questions asked, company will simply accept my returned product. So that's the definition of legal obligation as well as constructive obligation. Now, I told you that this standard relates to 3 things. One is provision, the other is contingent liability, and the third is contingent asset. The first part of provision related definitions we have covered. So we have covered provision, liability, obligating event, legal obligation, and constructive obligation. Now we come to contingent liability. Here, again, the word liability is still there, which can take us back to the definition of liability, a present obligation, right, arising from past event to be settled in terms of transfer of economic resource. But what is the word contingent specifying? Contingent liability is a possible obligation. Remember, liability is a present obligation, whereas contingent means a possible obligation. Because it's an obligation, there has to be a triggering event, which we call as past event. But the only thing is, the existence of this obligation will be confirmed only by occurrence or non-occurrence of a certain event, future event, not past. Which is of course not wholly within the control of the organization or the entity. You had sacked one employee, for example, and the employee has put a case in the court of law against your company claiming some big amount of compensation. Like, court decision is not in your hands, it's out of your control, right? So it cannot, just because there is a claim against the company, it doesn't create any present obligation for you. It may create a possible obligation if the court ruling goes against the company. So occurrence of that event is what? Court case going against the company. But court case going against company can be confirmed only in future period of time. And therefore, this cannot be a present obligation, but a possible obligation. So a present obligation arising from past event is not recognized because it is not probable that outflow of resources would be required to settle this, and the amount of obligation cannot be measured with sufficient reliability. So this is a subset of this definition. So even if you feel okay, the event is likely to create a present obligation for you, it is going to arise from the past events, but still you don't recognize it as a provision. Why? Because there is no certainty, there's no probability that you will have to settle it by transfer of economic resources, or you are unable to measure the amount of that obligation with a sufficient amount of reliability. Now, when we say that, look, there has to be a probability of the outflow happening. When we talk about probability, to recognize an expenditure, we typically say that it should be more than 50% probability. Less than 50% probability probably may not be enough for us to recognize the provision or recognize the liability in the books. So these are the things that are mentioned in the subset of that contingent liability definition. Like there is a contingent liability, there is a contingent asset as well. Like you have made a claim on some party in the court of law, case may go with you. In case it goes with you, you will get a payment from the other party. So it's a contingent asset. Why contingent? Because whether that money will be received or not is contingent upon court case going in your favor and not against you. So again, it is not a present asset. It's a possible asset. Again, arising of course from past event, and existence of that asset will be confirmed only by occurrence of one or more uncertain future events, which are again not within the control. So, the definition is simple one because it's exactly opposite of the definition of contingent liability. Whereas contingent liability is a possible obligation, contingent asset is a possible asset. That's the only difference. Let's look at some of the other, but still important nowadays, because this is arising out of latest amendment that was made effective from 1st of April 2022, and that's related to onerous contract. Within the simple meanings of a common man, common woman, onerous contract is a contract which is essentially going to be loss-making. That means the cost of fulfilling that contract is expected to be more than the benefits that the company is going to receive by satisfying the contract. That's called as onerous contract. So what is the necessary part of this definition? A contract that exists between a party and an entity in which unavoidable cost, if the costs are able to be avoided, yes, the company will always avoid it and there will not be any loss. And therefore, the nature of the cost should be such that it has to be unavoidable cost. Cost of what? Cost of meeting obligations under that contract that the company has entered into. And these unavoidable costs are more than the economic benefits that you are expected to receive from it. What is the importance of this definition? I'll come to that a little later. There is also one past event, one specific past event that is defined in this accounting standard, and that is related to restructuring. If these conditions mentioned within this definition are satisfied, the company needs to create a provision. That's why these two definitions are specific events for which the company must make a provision in its financial statements. And you know very well that provision on one hand will increase the liabilities and on the other hand will reduce the profit for the period. So for these two events, onerous contract and restructuring event will be that kind of a obligating past event. So what is restructuring? It's a program that is planned. So it's very clearly defined. It has to be planned and controlled by management. Unplanned or uncontrolled program cannot be called a restructuring program. And once this program occurs, it is going to materially change either the scope of the business undertaken by the entity or the manner in which the business is conducted. I'll give you examples of both. Let's say there is a retail store, retail company like Vijay Sales, for example, or like Reliance shops, you know. Reliance tomorrow takes a decision to close some of its retail stores. Let's say in a Bangalore city, there are some 15, 20 stores today. The company decides, fine, I mean, 6 or 7 of them we are closing. Company has planned for it. The decision is entirely controllable by the management of the company. It's their decision to close down those retail shops. And what it has materially changed? It has materially changed the scope of business undertaken. Very clearly. Another example I will give you where we'll see the change in the manner in which the business is conducted. I'll continue with the same example of Reliance Retail. Company decides that, look, we are going to close all retail showrooms, all, and the business will only occur online. So if you're going to get into a change in the distribution channel, no retail stores, only online business. The manner in which business is conducted is being restructured in a planned way within the control of management. Any such program that is planned and controlled by the management, changing either the scope or the manner in which the business is conducted, will result into an obligating event, and if it does, company will have to make a provision in the books. That's what you should remember very well. So after having understood very effectively the important definitions, please remember I have concentrated yesterday also and today also on covering of some very critical definitions from the standard, not all. But if you go through the standard document, naturally you'll find other definitions also. Not that they are not important, but of course, I mean, they are not as important as the ones that I have discussed just now. So we understood objective, we understood scope, we understood some important definitions. Now we know that in order for the company to be required to make a provision in the financial statements, it has to first decide whether there is a triggering or obligating event created, and when it does get, it will have to recognize the liability. Provision is a liability, we have seen that. So let's say, what is the way in which the principle of recognition is provided for in this standard? A provision is recognized when what? Three things happen simultaneously. There is a present obligation. Now this, we know, this obligation either can be a legal or a constructive obligation. And there has to be some obligatory event that, in terms of past event, that has already occurred in the past. Past could be even a very, very recent past, 5 days ago, 10 days ago, 1 day ago, or it could be a distant past, 6 months ago, 1 year ago, whatever. Second thing, that this present obligation would result into outflow of economic benefits. The standard says outflow of economic benefits should be probable. That means the probability should be more than 50% to settle the obligation. It's the now, how does one decide 50% less or not, or more or not? High element of subjectivity. But then, of course, a professional judgment will come into picture when you want to decide the probability. So there can't be a standard answer to how does one decide that there is a 50% or more or 50% or less probability that there will be outflow of economic benefits. Of course, if you read the standard in depth with all these nitty-gritties, you will find some guidance given on determination of the probability and use your professional judgment. And the third important thing is, we know a provision is a liability with uncertain amount. So if the amount is uncertain, and timing also, but if the amount is uncertain, you should be able to make a reliable estimate. Because you know, if the amount cannot be determined, how will you recognize a provision? So three things: existence of present obligation from past event, the outflow of economic benefits has to be highly probable, more than 50%, and third, you should be able to make a reliable estimate of what is the amount of that economic benefit outflow is going to be. All three satisfied, provision gets created. Now there may be a question in our mind: if they're not satisfied, obviously the provision will not be created. But then, if it's a major event, material event, we will have to disclose this fact. Either it may become a contingent liability, if at all the definition of contingent liability is satisfied, or it could come in terms of a note from the management in its management commentary and future outlook kind of a thing. But useful information explaining as to why the provision is not made should be provided by the organization. So that's why I'm saying, practically speaking, tell the students when they are learning from you, can you avoid the obligation through your future actions? If the answer is yes, no provision is required. If the answer is no, provision will be required, no doubt. Simple, very simple. So recognition principle, three things: present obligation, past events, economic benefit outflow probable, highly probable, and reliably you should be able to estimate the amount of provision to be made. Let's come to measurement now. The previous slide showed us only one fact, a reliable estimate of the amount to be paid, amount to settle the obligation. But reliable is what, and how do I measure that reliable amount that is specified over here? So again, a set of principles is given. There is no direct answer given here in terms of quantum, in terms of numbers. No, you will have to use your judgment in such a way that you will be able to convince all your stakeholders why that amount is being decided in the interest of all the stakeholders. And therefore, they say it should be your best estimate. Best estimate. Of course, when you say estimate, you say, okay, I think travel related, I should be making a provision of 5 lakhs of rupees. Where from these 5 lakhs have come? The best estimate, when you say, you should say, hey, there have been 10 trips to these places. Approximate air tickets would be so much. Approximate number of days spent are so much. So the hotel expenditure, the food expenditure, the conveyance, etc., etc. So there has to be a logic built in arriving at this best estimate. If you sell your products and you are giving warranty with the product, 1 year warranty of performance, you should have a best estimate of, okay, how many products are likely to fail? How many products will come back to you within warranty period? How many products, if they come back to you within warranty period, would require minor repairs? How much would require major repairs? How much would require complete replacement of the unit? All these will be based on the best possible estimate. Of course, the previous history, your past experience can help you out in coming up with this best estimate. But yes, still there is a lot of subjectivity, and that's why you need to establish the fact that you have used your professional judgment very well. So simple principle stated in the standard is, yes, provision has to be measured according to your best possible estimate, based on, of course, the things that I just narrated. Because the provision is required to be made at the end of the reporting period. It doesn't say at the end of the year, please remember. So if your reporting period is a month or a quarter, you have to do all these estimations at the end of each reporting period. For listed companies, for example, every quarter they have to report. And therefore, estimations will have to be carried out at the end of each quarter, as if the obligation is going to get settled then and there, that time, end of the period. And then you, as I said, you use your judgment and experience of similar transactions in the past, or if at all you have no history, then you can seek experts' opinion on that. If provisions like warranty, as I said, are to be made, large population of items, iPhone, for example, lakhs and lakhs of units are sold on warranty every day, every month, every year. How can one make a provision on each and every individual phone sold? No, that cannot be done. So what do? You just create some kind of percentage, as I said, and use expected value method. So it's like a joint probability calculation that you will have to do. I think I have a small example on this, which will make things clear to you. If it's, I mean, still it's going to be very simple, because you say, hey, 80% of the products will not come back. So naturally, 80 into 0. You're not going to spend any money on warranty related to 80%. So total quantity sold into 80% into 0. That will be the provision for that 80%. 5% of the products coming back will have minor repairs. and each minor repair is likely to cost you $20. So 20%, 5% multiplied by total units sold multiplied by $20. That will be the provision required. You pull all these calculations together, and that's called as expected value. Simple meaning of the term expected value is nothing but weighted average. You take weighted average and your job is done in real life. If provision is like a single obligation, the most likely outcome it is the best estimate. Meaning thereby, you are selling one machine and you are selling that machine only for once to the specific customer. A machine that is made only for that customer. It's not standardized. So it's a single obligation. So you can go by your own best estimate for that machine as such. It's not a large population of items like iPhone example that I told you earlier. Let's come up with one simple example to begin with. Yeah, this is, I think, the warranty related expense provision. Entity sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that become apparent within first 6 months after purchase. So it's a 6 months manufacturing defect warranty. And the warranty is not going to result into replacement of the product, but they say, hey, the default will be rectified without any cost. So it's like an insurance given to the customer that, look, if at all it requires any repairs to rectify the manufacturing defect, company will bear that cost. Customer will not have to pay a single pie. If a minor defects were detected in all the products sold, the repair cost of rupees 1 million would result. And if major defects were detected, the repair cost will be 4 million. Now, the best estimate, the probabilities, based on past experience. Entity's past experience and future expectations indicate that for the coming year, 75% of the goods sold will have no defects, zero defect. That means they will not come back to you highlighting manufacturing defect within a period of 6 months. And if it comes after 6 months, the company has no liability. Customer will have to pay for any repair cost. 20% of the goods sold will have minor defects and 5% will have major defects. So how do we decide the amount of provision to be made in the books? It's an expected value or a weighted average, as I said. Entity will assess the probability of outflow for the warranty obligations as a whole. And the expected value, as I said, will be calculated simply 75% of the quantity sold, 0. 25%, 20% of the quantity, 1 million. And 5% of the quantity will be costing you 4 million. So expected value will be 400,000 rupees, which at the end of a reporting period, the company will have to make a provision of in its financial statement. So that's how the decision related to warranty provisions is always made. I told you that I'll come back to you with why onerous contract as a concept. We saw that concept, right? Definition. Why is it important? Because for onerous contracts, company will have to make a full provision of the loss that is estimated to be resulting from existence of such contract, where unavoidable cost of fulfilling the contract is more than economic benefits that will flow to the entity. Let's look at this. It's a contract that is entered into with another party under which unavoidable costs of fulfilling the terms exceeds the economic benefits. That means there will be cost more than the benefit, resulting into a loss. Simple. Onerous contract, therefore, as I said, simply is nothing but a loss-making contract. Unavoidable cost would mean what? it's a net cost of exiting from that contract. If you feel that okay, the contract cannot be profitable for you, you exit out of it. But then exiting out of a contract may require you to pay some compensation to the customers. So that's unavoidable cost, and that cost you have to provide. How do you calculate that unavoidable cost? So the standard has made it clear that these unavoidable costs will be lower of the two amounts. Which of the two amounts? One is the cost of fulfilling. If you go ahead and complete all the contract, whatever is the cost to complete the contract, that will be first. Second, any compensation or penalties arising from failure to fulfill it. As I said, if you have agreed that if the construction is not completed at the end of the month of December, let us say, the client will get a compensation of 2% of the contract price, a penalty, liquidated damage, or whatever. So you calculate both these amounts, and the lower of the two will have to be provided. This is like a rule, no questions to be asked. You take these two amounts, lower of the two, you make a provision in the books. So that's how onerous contract will have to be dealt with. If entity has a contract that is onerous, that is a loss making or likely to make losses, present obligation under the contract has to be recognized. That means you will need to make a provision in the books. So here just a pictorial presentation. Unavoidable cost, the weightage is more than the economic benefits. That's what it will show. This picture will show. And it has given, the standard has also given some of the examples of cost of fulfilling the contract. It can include, let's say, direct labor, direct material to fulfill the remaining part of the contract, or some of the overheads that are allocated to it. Allocated depreciation for the plant and equipment that is used, property, plant, equipment that is used. Simple examples. Of course, every industrial sector, every type of business will have different ways of, coming up with examples of direct and indirect costs related to onerous contract. You should be able to attribute it to the contract. Another type of a transaction for which a provision is required is this restructuring provision. We have seen the meaning of restructuring. A program controlled and managed by the entity, and then that is going to change the scope of the business or the manner in which the business is conducted. That's how we have defined it already. It's a program planned and controlled, as I said, by the management. And these two things we have already seen that. Examples: sale or termination of a line of business. A company was engaged in production of bulk drugs as well as pharmaceuticals, and it decides to stop manufacturing and selling of bulk drugs. It's under the first one, sale or termination of a line of a business. Closure of business location or relocation to another place. I gave you the example of closing of retail stores by, let's say, Reliance. Changes in the management structure, meaning, okay, currently the company operates 3-tier management levels. Tomorrow it decides we'll wipe off one and there will be only 2 tiers. Rest all the employees will be asked to leave. Or there could be some fundamental reorganizations, merging of 2 organizations, which will result into a lot of people becoming redundant. A lot of synergy benefits are expected. So even the resources can be combined. Some of the resources can be made redundant. All these are business restructuring matters. They are planned and controlled by management. And once you find that, a provision will have to be made in the books. Now, how do you decide whether an obligation is created for restructuring? So there are certain conditions which the standard has mentioned. Typically 2 conditions. One, there has to be a restructuring plan in place. Second, of course, the plan has to be communicated to all the affected parties. And this communication should create a valid expectation in the affected parties that yes, the restructuring will be carried out by the company. So it's not something which is unplanned, uncommunicated. It has to be planned and communicated well in advance. For example, if voluntary retirement scheme is being made, there has to be a detailed plan for voluntary retirement scheme. Which category of employee does it apply to? How many maximum number of people can take advantage of that? What sort of compensation will be paid to the leaving workers, etc., etc. Everything will have to be planned, and it has to be communicated to the workers. Either you can communicate through the trade union, or you can directly send out emails in this modern world. You need not put a notice on the notice board, but you can send email, or you can send WhatsApp messages, or whatever. Manner of communication is not important, but the fact that communication is made, it carries more weight. So if these two conditions are met, you assess as to how much provision that needs to be made, and you list down all the costs that are related to this program, make a provision at the end of the reporting period. Sometimes management will give you information that, look, we are thinking of coming up with a VRS scheme. Now, merely deciding that, okay, there will be a VRS scheme, that doesn't mean the restructuring provision is required, because there is no detailed plan for VRS, and there is no communication made it to the workers or employees. So only management decision and recording of that decision in the board meeting is not sufficient. You would have to have a detailed plan, and you would have communicated that plan to the parties that are aggrieved or affected party as such. So if at all a restructuring event exists, what sort of costs you need to include while creating restructuring provision? Remember, only direct expenditure arising from restructuring that has to be included. For example, if you're closing down some retail outlets, direct expenditure arising from this closure will be what? Compensation payable to the employees who are leaving the organization. It will also mean, okay, selling of your store assets at a certain value which is lower than the cost. So there is a loss on sale of those. You may have to pay certain compensation if you're pre-closing the lease of the property. Only directly related expenditure, no allowed expenditure, no. These expenses must necessarily be required to be incurred because of the restructuring. That means if you won't have closed down that retail shop, you would not have to, pay compensation or pre-close the lease. And it should not be associated with ongoing activities. For example, if your company decides to close down a retail shop, and if in that retail shop there are 20 employees working, you say 10 will have to leave, and the other 10 will be absorbed in other divisions for which we are giving them the training. Now, in the restructuring provision, what would you include? Number one, you will include the compensation that you are going to pay to the 10 workers or 10 salesmen who are leaving the organization. You are going to incur some training cost for the remaining 10 who will remain with the company but will be absorbed in other roles for which you are going to train them. This training expenditure is not restructuring expenditure because it is related to ongoing activity. Those employees will remain with you and carry on the other business activities for you. So only compensation paid to leaving employees will become part of restructuring provision. Now, these are the type of questions that we should set by giving very small caselet to the students. Let them put thinking hats on their heads rather than rote learning and just asking them, okay, give the provisions related to restructuring. No, that's not the type of question that we should ask them. Give them caselets, and that's what will help them to think. And those are the students who will stand out in the job market because they can think, they can apply learnings. The standard has made very clear, that following costs will not be included in restructuring provision. What are they? Retraining. I gave you the example of retraining or relocating the continuing staff. No. The company may include some promotion or marketing expenses. That look, we are closing our retail, so whatever the goods are available, we will sell at a very low price. So this is the advertisement given in the newspapers or televisions or any social media, etc. The cost of such marketing will not be part of restructuring provision. You may decide that, look, now you will close all the stores and you will start your online business, for which you will have to incur expenditure in creating the new computer systems and a new logistic distribution center. Those are not part of restructuring provision. So this is again the last part that I explained to you. Those three things, they're not principles, they're like rules. No questions to be asked. Why you should not include them? Standard says so. I can't help it. Right? So what we have seen so far is, of course, very, very comprehensive learning about the objective, scope, definitions, recognition, measurement, specific events like onerous contract and restructuring. And that's the way to learn accounting standards. Recognition done, measurement done, disclosures. How do you disclose the amounts of, the amount will come under the current or non-current liability as the case may be, with the description as provision for such and such thing. I'll show you how a certain company has disclosed this at the end. What you have to show is carrying amount of the provision at the beginning of the year and at the end of the period. How much additional provision towards the same have you made during the year? Amounts that you have utilized out of provisions this year. That means those liabilities have been actually occurred and you have settled them. So no more provision is required now because the liability gets settled. And then unused amounts which are reversed during the year. You feel that no longer the provision is now required. So you just reverse that and reduce your liability. So this has to be disclosed. Contingent liability, simple. It will not form part of balance sheet. It will not form part of profit or loss account, neither cash flows. It will come and appear only as a note in the financial statements, giving a full description of the nature of the contingent liability, because it's not a present obligation, it's a possible obligation. Estimate of its financial effect, indication of uncertainties that exist, and possibility of reimbursement, if at all you are able to reduce that estimated contingent liability. So let's look at certain things. Now, these next 4-5 slides I have directly taken from the actual document of accounting standards, and that's how you will be seeing here some of the references to paragraphs. So here, for example, there is a reference to para 14, para 27, para 84, 85, para 86. All these references are to the paragraphs of the accounting standard. A standard will always have the principles given in the paragraph, and they are pre-numbered. So because I have taken it directly sourced from the document of accounting standard 37, Ind AS 37, these paragraph references are there. So those who are interested in looking at this at more depth, they should quickly refer to the Ind AS 37 document and look at those paras. So what is the essence of this? The first thing this snapshot shows is related to provisions and contingent liabilities. So it says, if there is a past event which embodies outflow of economic resources, and these are the past obligatory events whereby either they will require you to settle present obligation or a possible obligation. If it's a present obligation, provision is required. If it's a possible obligation, it's a contingent liability, which is not within your control at that point in time as of the end of reporting day. So if there is a present obligation that requires an outflow of economic resources, of course, provision is recognized and you will have to disclose the details of the provision, as I said. If there is a possible obligation, right, there is no provision that you require, only disclosure. Provision is not required, only disclosure is required. If there is a possible obligation or a present obligation where outflow of economic benefit is remote, that means it is having lower than 50% probability that I explained to you. If that happens, neither any provision is required nor any disclosure is required. So it's something which can help you to understand as a flashcard very quickly the essence of this accounting standard. Similar snapshot is created for contingent assets, which is exactly opposite of contingent liability, as I said. So if there is a inflow of economic benefits, if that inflow is virtually certain, asset is not contingent, it becomes your asset, real asset, and you show it like that. But if the inflow of economic benefits is probable only, but not virtually certain, you still can't recognize it as an asset because it's only probable, not certain. Then you have to disclose that as a contingent asset. But the inflow itself is not probable. You neither disclose it as an asset nor any other disclosure is required. So this is the way for you to understand whether you will be recognizing it, at what value you will be recognizing it, and what sort of disclosures you are going to make. Right? So such snapshots are really going to be very helpful to be included within your teaching. That will help students to understand the thing and summarize it in the most beautiful manner. Let's look at this flow chart. You can make a similar flow chart to the yesterday's accounting standard that you could take it up as your own exercise, homework. So how do you start asking questions to yourself? What is our objective? Objective is to decide whether I'm making a provision or not. So ask yourself, is there a present obligation arising from past event created? So this is my first question. If the answer is no, then if it is not a present obligation, you ask yourself, is it a possible obligation? If the answer to that is no, your course of action is clear. Do nothing. Neither a present obligation nor a possible obligation. Do nothing. Simple. If it is not a possible obligation, is it remote? If the answer is yes, it is remote, again, do nothing. If it is not remote, then disclose it as a contingent liability. If it is not a possible obligation, but a present obligation, is the economic benefit outflow probable? If it is not, ask yourself, is it remote? If answer is yes, do nothing. If it is not remote, recognize that also as a contingent liability. But if outflow is probable, more than 50%. Can you make a reliable estimate? If no, although the standard setters have said these things can rarely happen. So if no, disclose it as a contingent liability. If reliable estimate can be made, provide. So remember the slide on which I had said when to recognize? There are three things to be satisfied: present obligation of past event, probable economic outflow, and reliable estimate of the amount to be recognized. All three getting satisfied, provide. All three not getting satisfied, either disclose as contingent liability or do nothing, depending on whether it's a possible obligation, probability remote or not. So again, this is one of the way in which you can change your teaching pedagogy to make students aware of the essence of accounting standards, and let them understand it not as a binary operation, but let them you can help them understand. And what you could do actually is to give them a small case in a descriptive manner and say, hey, create this chart for that particular case and arrive at your final answer. That's the beautiful way of saying. Now let's look at some of the examples. I've deliberately included some of the examples directly from the standard document, AS37 document. This first example is related to warranty expenses. And what is stated? Manufacturer gives a warranty at time of sale to the purchasers of the product. Under the terms of contract, contract of sale, the manufacturer undertakes to make good by repair and replacement manufacturing defects that become apparent within 3 years from date of sale. 3 years. On the past experience, it is probable. Probable means more than likely, 50% and more, that there will be some claims under warranties. So what is the question that you are asking yourself? First question, is it creating a present obligation from a past event? So what is a past event? Obligating event? Sale of the product to the customer is a past event with a warranty, of course. And what sort of obligation it creates? It's a legal obligation. Why legal? Because there is a purchase and sale contract between you and the customer. Any contractual obligation is a legal obligation because it can be enforced in the court of law. Second question that you need to ask is outflow of economic benefits going to happen? If it is probable for the warranty as a whole, because it's a larger population on which you will do it, as I said, then what do? Your conclusion, yes, a provision is recognized. At what amount? Best estimate of the costs of making good under the warranty products. And I've given one more example to you, 75%, 0, etc., etc. So that is the way your best estimate the expected value that you can calculate, which is nothing but a weighted average. So that's a simple example. Second example is there's some contamination of land. Let's see what is the situation here. And these are you can also develop cases, small cases from newspapers, from any news regarding any organization. Just pick it up and say whether the provision will be required by this company or not. An entity in the oil industry causes contamination but cleans up only when required to do under the laws. One country in which the company operates has no legislation requiring cleaning up. If there is no legislation that mandates cleanup, that means there is no legal obligation, obviously. An entity has been contaminating land in that country for several years. Currently, there is no legislation. At the end of certain reporting period, it is virtually certain. It is virtually certain. What is the certain? That a draft law requiring cleanup is already is in the process of being enacted shortly after the year end. Law requiring cleanup. Currently, there is no legislation, so no legal obligation, but a law is coming, and that's virtually certain that the law is coming. So again, ask yourself, present obligation from past event. What is the past event here? That the company is contaminating the land. That's the past event. That's giving a legal liability now because it is virtually certain that the law will come. And naturally, because you are contaminating the water and because the law is there, economic benefit outflow is probable. Provision will be required. And how will you calculate that provision? You will calculate taking into account the best estimate of the cost of cleanup. That's what you will do here. Best estimate of the cost of cleanup. Another example. Again, same example, but slightly different. What is the slight difference? Let us see. Entity in the oil industry causes contamination, operates in a country where there are no environmental legislation. There is nothing. But the company has widely published environmental policy in which it undertakes to clean up all the contamination that it causes. And the entity has a record of honoring this published policy. So there is a published policy, there is no law. So what is the obligating event? Contamination. But although here there is no legal obligation, because the company has a policy and it is honoring that policy, it gives rise to constructive obligation. Economic benefits of cleaning up, probable, best estimate, provision is required. This is simple way of giving small cases to the students and asking them to, make decisions. And one or two examples you tell them, and then give them the cases. Let them write these, ask these questions. It becomes very easy. You can do it in groups as well. Very, very interesting. Those people who say it's a dry subject, it can be made interesting if we desire to do so. Refunds policy. A retail store has a policy of refunding purchases made by dissatisfied customer. I gave you the example of Amazon, right? 7-day return. Even though it is under no legal obligation to do so. What is the past event? The sale of the product. You have sold, which gives rise to, again, a constructive obligation. This is not legal. And why? Because the store has created valid expectations on the part of customers that, okay, if you're dissatisfied, return, company will accept that return. So outflow definitely probable based on your past experience. If there is no past experience for your company, you can draw that experience from the market. This is the best way of, making the standards principle based. And of course, the best estimate of cost of refunding, that will be provision. So that's how this example can help you out. Closure of a division. I gave you similar example earlier. You're closing down a division, and before the end of reporting period, the decision was not communicated. Now, closing down a division will change the manner in which the business is run or will alter the scope of business. But here, this decision is not communicated to parties who are going to get affected, and neither the steps required for the implementation of decision are carried out. So there is no obligating event because the plan is not communicated. There is no obligation. No provision is required. No provision is required. So this is how different cases can be given where the conclusions can be differently made. Closure of the division. Now here communication and implementation before the end of reporting period is made. So board of the entity decides to close down a division which makes a particular product, and on a certain date before the end of the year, 20th December, let's say, a detailed plan for closure was agreed by the board. So management has taken a decision, and letters were sent to customers warning them to seek alternative source of supply, and redundancy notices were sent to the staff of that division. This is going to definitely require a restructuring provision. Closing a division will change the scope of the business. What is the obligating event here? Obligating event is not decision to close down, please remember. Obligating event is communication of the plan to the affected parties. That is going to raise expectations in the minds of those affected that yes, something is going to happen. Valid expectation. And yes, outflow of economic benefits is going to happen, probable, and best estimate of costs will have to be made, and provision will have to be made on the end of the reporting period, which is 31st of December. So these are the examples which I think you should include in your teachings always. A court case, right? Because of some reason, after a wedding, 10 people died. And the cause of death was possibly food poisoning from the products that the entity sold. Legal proceedings have started seeking damages from the company, but the company has disputed the liability. Naturally, it has gone to the court. Up to the date of authorization of financial statements for the year 31st December X0, the lawyers advise that it is probable that entity will not found liable. Entity will not be liable. However, when the entity prepares financial statements for the next year, 31st December X1, lawyers now advise that possible that there will be a liability created. So there are two reporting periods we are talking about, 31st of December X0 and 31st of December X1. On the first date, first closure, present obligation, based on the evidence, no obligation that has arisen out of, so there is no obligating event. Naturally, no provision will be required because there is no outflow of economic benefit is going to happen. But at the next one, obligating event, there is a present obligation that some kind of compensation the company will have to pay. Outflow of economic benefits is also probable, and therefore a provision will have to be recognized in the books. Now, this is what I said. I'll show you at the end the actual disclosures that are made by companies. I will include a couple of examples here. One is the Bajaj Auto. Other I will show you of L&T. Now, provisions are. This is the presentation part. Although I have not discussed the presentation principle from this standard, because we have discussed it yesterday in a general discussion, but essentially every provision will have to be categorized either as a non-current or current. The one which is expected to be settled within a period of 12 months after the closure, current. Rest all is non-current. So provisions that are related to employee benefits and other provisions, this company has included warranties. And how the warranty provision has been made is also made clear. Estimated warranty claims in respect of vehicles sold, which are still under warranty at the end of reporting period. The claims are expected to be settled in the next financial year. Estimates of the provision based on historical warranty claim information. Trends are found out and some estimation is done. And then, as I said, what you have to disclose? What is the provision at the beginning of the year? How much additional provision is made during the year? How much is utilized? That means this provision is no longer required, and therefore this is the balance of the provision at the end of the year. Of course, you will have to always give the previous period's figures as comparatives for the user to understand whether there is an increase in the amount of provision. And you can find that there is an increase over here by 5 crores of rupees nearly. Bajaj Auto. I have selected L&T, but I have not given the same provision table. Now, what we have listed here are the contingent liabilities. So these are not present, but possible obligations, and see the areas in which all these obligations. claims against the company not acknowledged as debts. So the company has disputed. They say, no, that's not our obligation. Sales tax, GST liability, which are in the appeal, excise duty, service tax, income tax, bank guarantees and corporate guarantees given on behalf of subsidiary companies, share in the contingent liability of joint operations that are conducted by the company, indemnities given for performance on behalf of third parties. And look at the amount. This is a huge amount. Tomorrow, if everything materializes, from user's point of view, this information is really important. On the whole, you will find it's in excess of 1 lakh crore. 1 lakh crore. If everything materializes, the company will have to be bankrupt. But this is what is the discussion, and how the user can therefore analyze the company's uh, performance or company's status. Look what has happened here. Corporate and bank guarantees have reduced by 4,000 crores. But look here, the corporate and bank guarantees for performance about subsidiary companies, that has gone up by 30,000 crores. So investor will be a little worried. Why is the company throwing away such bank guarantees and corporate guarantees for subsidiaries? Which are those subsidiaries? What type of guarantees are given? How much likely is it that those guarantees will actually fructify? All these aspects, because this is providing useful information to the stakeholders for them to be able to take their own decisions about investment or about doing any kind of business with the company. So these were the examples. Now, yesterday I had told you that I'll let you know about certain resources for learning the Indies. I have listed some of the books and some of the links to the internet. Now, of course, after this session, I'm going to send you the presentation files through the SSMRV college, of course. You will get it. So these are the resources which you could look for yourself and then satisfy yourself with the additional learning, which is always going to be very, very helpful for you. So that's it from my side on Ind AS 37, and generally on what you could learn in terms of your additional knowledge as such. So this is what I want to share with you. That's it. Thank you. If there are questions, as I said, I can take the questions now. You could type the questions in the chat box, or if the college permits, you could raise your hand and get yourself unmuted and raise the question.
Good afternoon, good evening, participants. As of now, we don't find any questions in the chat box.
I also
in
saw
the
no
interest
questions in the chat box. If they
so,
want to ask online now also.
yes, we can just to, in the interest of time, like we can allow a couple of questions. Can anybody who's interested to ask questions raise the hand, please, so that we can ask them to unmute and ask a question. Participants, it could be regarding yesterday's discussion or today's as well. Either way.
Today's discussion.
Yeah, either way. The session is open for questions now. Any need not be questions alone. Anything, your comments or feedback on any of the topics that we discussed, your take on it, that can also be considered.
Okay, I think there are no questions, sir. So we can proceed to.
Hello, am I audible?
Yes.
Okay. So before we formally end the session, we would like to request Nagraj sir, Dr. M.S.
Mm-hmm.
Nagraj, Head of Department of Commerce,
Mm-hmm.
uh, to uh, to provide the closing remarks for the session. Nagraj sir,
Okay.
over to you.
Yeah, thank you, Gokul. Good afternoon, all. Sir, good afternoon, sir.
Good
It's been
afternoon. Very good afternoon.
long time, sir. We had a couple of events in the college, and there's a continuous collaboration with you. I think
Yes.
most of the programs, when it pertaining to anything relating to accounting and Ind AS, you are the person. It's a top of the mind. Your name comes up. So thank you very
Thank
much
you.
for collaborating with us. Um, and I just wanted to tell all my colleagues who have been listening to just say that day one, it was Ind AS 37, which is liability based accounting standards. That is what you have spoken about. And today you spoke about revenue from contract
No,
with
it's reverse,
customer.
sir. It's reverse. Yesterday was revenue. Today was provisions. 37.
Okay. Sorry. I just made a mistake. Thank you very much for correcting. And I think you had given a live examples, case studies. We can understand the depth of your knowledge in this particular subject, and the no questions from any of the participant will also suggest the amount of understanding they require in order to get into the depth of this particular topic. So that's the one thing that I have to appreciate you, sir. It's so nice of you. For 2 days you are continuously being with us, and you've been addressing. Thank you very much.
My
And
pleasure.
when I have to speak about my college, the SSMRV college has its unique model in which we concentrate more on students as well as faculty empowerment. So in under faculty empowerment, we have this accounting club, which is one of the club which is associating with you for conducting this event. Um, this is, and we have n number of academic clubs. Under each of these academic club, these academic events are happening. And I want to thank all the participants. See, the participants are so loyal to us. It's been n number of activities that we have done, not only in accounting club, but any other activities also. So the support that the participants are giving to us is our strength, which is making us to come out with new academic activities, engaging you all and enriching the knowledge. That is what is the whole purpose of having this academic events. Of course, few might say that this is only for a certification. No, it is not for certification. It might be one of the criteria, but our intention is to say, spread the knowledge, not only in terms of accounting, but all any of the subjects which the participant wish to uh, want. So in your feedback, participants, I request you, if you have any specific topic that you would suggest us to conduct, we are ready to do so. So thank you for being loyal, and we hope that you would extend the same type of cooperation in all our future endeavors. Thank you. And I understand the patience of all the participants. Because after the completion of your classes, you have been coming here, listening to this. So uh, thanks for your patience. Thanks for your uh, uh, appetite for the knowledge. And second thing that I have to uh, talk about is about our principal. So Dr. Geeta Madam, she has been a support to us. She has been guiding us for these type of activities. Thank you very much for your guidance, Madam. And all our faculty members in my department, they all have collaborated. They all have come together, and they have contributed towards the success of this program. And I have to thank our accounting club convener, Dr. Sri Hari, and all the members of the accounting club who have been part of this. Of course, students are also supporting us. There is a technical support which happens from our back end. For all these purposes, it is the students who are helping. So thank you very much, students, for this. And I wish all my participants a very, very happy learning, a very good evening, and have a great evening today. Thank you. Over to you, Gokul.
Thank you, Nagaraj sir. So now we'll conclude with the formal vote of thanks. So it's my pleasure to uh, say a big thank you to CMA Milind Date sir. Of course, sir is no stranger to us. Sir has been a well-wisher of SSMRV College. He has done a lot of events here, both online and offline. So thank you so much, sir, with all your support. Anytime we call you, you are there amidst your busy schedule. Amidst your busy schedule, you are there with us. Thank you, sir. Thank you for being a big support to us, and thank you for taking the session wonderfully for the from the past 2 days. Then next is the head of the institution, our beloved principal, Dr. Geeta ma'am, who has been a pillar of support for all the initiatives that we have been taking. So thank you so much, ma'am. I'd like to thank Dr. Nagaraj MS, the head Department of Commerce, who always extends his support for all our endeavors, all our academic endeavors in the Department of Commerce. And he also has an extended role as an IQAC coordinator. So thank you so much, Nagaraj sir. I'd like to thank Dr. Srihari, who is a very good friend of Milind Date sir, and who has been coordinating this event for quite some time now. Thank you, Srihari sir, for being a big pillar of support and having ensured that we get the best out of this event. Thank you. I'd like to thank others from the accounting club. Vidya ma'am, who's a member of the accounting club, Anusha ma'am, who's a member of the accounting club, Nandini ma'am, who's from the accounting club as well, and of course Mr. Balachandran, who's a student who has been with us for the past 2 days doing all the technical aspects, and of course our technical team of Mr. Raviraj and Reddy. And a big thank you to all the participants, both from the academic and the corporate fraternity, for having spent your valuable time amidst your academic and corporate schedule to listen to Milind Date sir. As far as we have sent the link of the feedback, we have sent the link of the feedback both on your chat box, as well as we'll also be sharing it in the WhatsApp group. And please give us about 3 to 4 working days to generate the certificates for us. Yeah, the PPTs of the past that's all from our end today. So thank you once again, all of you, for your patient listening, and thank you once again.
My pleasure, sir. Thank you very much.
Thank you, sir.
Bye.
Yeah. Participants can now exit the session. Thank you.